did with the previous panels, I'm going to ask each of you just to introduce yourself to the audience and explain what your business does, and then we're going to open up the conversation about where we're going in this space. So if we start down the end, please.
Sure. Hi, I'm Shane Riedel. I'm the CEO of Elucidate. Prior to forming the company, I spent about 15 years in finance, most recently with Standard Chartered as the head of compliance for financial institutions. I started with Goldman, and before that I was a UN diplomat. The Elucidate as a company is a...
Really? We'll pass over that like it's nothing and tell us, what UN diplomat? That sounds fun.
Well, I worked for the UN Office on Drugs and Crime, their global program against money laundering.
Got any good stuff?
Yes. So it's actually a really interesting way to get your start in this particular area, right, because you see the social impact. But I was based in Vienna nominally, but in fact based in Almaty, Kazakhstan, and Tashkent, Uzbekistan for most of the time.
I had a friend of mine who was in Almaty. Somebody is for a company. He's in Almaty, and someone goes, "Oh my God, you're at the end of the earth." He goes, "No, but I can see it out the hotel window," which I thought was a good answer.
Not far from the truth.
Just to give these people, I know because I think it's interesting. Give these people a rough estimate of the size of the problem.
So the way we like
you were talking about the drugs and organised crime. That's 2 trillion, 2.5 trillion?
Yeah, I mean, the UN comes up with an estimate. I seriously question the methodology which sits behind it, but I think it's sufficient to say that this is a significant societal problem.
Yeah.
What the statistic we find most compelling is the fact that the banks are spending 3% of their revenue to manage that risk.
Right.
So
they're spending 3% to not manage the risk at the moment. So
exactly.
You guys are going to help them do better. Please, Shane. Next.
Hey, I'm Taavi, Tamkivi, and I'm a CEO and founder of a company called Salv.
But just to be clear for everybody else, he wasn't really on Twitter, on Tinder. That was just a joke.
I was just trying to create my...
Just clear for everybody in the audience.
I was trying to create my account there, but I didn't have time for that, sorry. But yeah, it's Salv, which is dealing with AML and helping companies to find more crime from their data sets, basically. And to be compliant as well. But being compliant is not enough. That's what I realized when I was working at TransferWise. I was fighting criminals, like attacks back in Skype already at TransferWise, and then I realized that this regulatory environment is pushing banks and other institutions in completely wrong direction. We heard a lot about KYC, KYB. This has been the main attention, but not actual money laundering detection. And that's the problem that we're resolving at Salv also.
Thank you. Please.
Hi, I'm Dave Christie. I'm Chief Executive of Bleckwen. We are a software company that specializes in developing AI software for anomaly detection in fraud and in money laundering. My background's ex-Chief Operating Officer for Euronet's money transfer division, so sending high-risk transactions around the world. So I would have been a competitor to you in your TransferWise days. And KYT, your transaction is a key element of understanding the risk profile of your client that you've onboarded in the previous discussions.
And what proportion of the overall, I mean, we've just heard 3% for banks. In a straight transmission business, what proportion of your business was this? 3%, 5%, 10%?
In the cash business, it was closer to 16%. In the electronic business, it was closer to 8%.
Right.
And typically, the smaller the organization, the more disproportionate the cost of this is to that particular organization.
It's a very specific problem. We'll come on to it in a moment as well. And Charles, so I wrote some nice things about you on my blog, but it doesn't mean we're dating or anything, right?
Yeah.
It's just, okay.
Yeah, no, so David and I have a long and very friendly history together. Back in 2016, we did a podcast with you, which was very well received. Yeah, so I think we are now like 270 people, like 500 clients who raised $40 million. I think when we first spoke, we had like 10 people or something. So yeah, I think...
but I pride myself being able to spot winners, Charles.
Yeah.
So thank you very much for that.
So yeah, and so we're the only global independent provider of AML risk data. So we have a real-time, algorithmically driven database of terrorists, money launderers, drug traffickers, criminals, and so we do the onboarding, the ongoing monitoring, and then transactional behavioral analysis for money laundering for global banks, payment companies, insurers, fintechs, yeah.
So he already turned down my Fintech idea was I was going to mash up his database with Google Maps so I could get a list of drug dealers that were on my bus route home. I thought this was just an absolute winner. Charles is such a spoil sport on these things. So we've established that colossal sums are being sunk in this for, frankly, not terrific returns at the moment. You guys are using technology to change that equation. So I wonder if you could just explain to the audience what it is, what exactly is it that you're doing with new technology which is going to shift this cost-benefit analysis? Can you be a bit more specific about how you're using new technology? Any of you?
Yeah, maybe I'll start. So at Elucidate, we're essentially like a credit ratings agency, but for financial crime risk. So we take data from banks, customer data, transactional data, employee data, control statistics. We run that through a proprietary risk model, and we score and ultimately predict and enable the pricing of financial crime risk.
I think in our case, back at Skype and TransferWise, I learned how people are effective in the crime fighting mission. And what happens is that if there are operational people who are able to look into the customer's eyes, at least virtually, and who are able to explain and understand what these people are doing, what like we are doing as a consumers, does it make sense if they go through our transactions, our links to other customers? So that's one asset that companies have. And the other asset is that they have people who can play around with data, like data analysts or data scientists or however we call them. And if there is a technology which allows these people, two people, to work together, like operational people finding out new strange things, then they're saying to analysts that can you please create the rule or the apology for that. Analyst types it into SQL, then operational person starts getting more accurate alerts, which actually he or she really wants to see. And this iteration between the data analysts and operational people is something that we embedded into our technology. So our customers are sending over their KYC data, they're sending over their transactional data, and basically we're just giving them like a tool where these two different people can work together.
So can I categorize that as kind of augmentation? You're using the technology to augment human analysts, is that the idea?
Well, it's like we're not that phase yet, but like we're getting there. But currently we're providing cool tools for the people to work together and to focus more and more on the actual outcomes of their work and not the formal part of the work, because that's ultimately the failure of the current system. Is like I can estimate maybe 80% of the effort that's put on by the regulators is going into the KYC. You need to know your customer, you need to go through the address verification, ID verification, all these background checks. So the whole pressure is going on that direction, and no one is actually telling you what to do exactly on this behavioral crime detection phase. And that's luckily enough, it's not too heavily regulated. They say that you need to do something, you need to fight crime, but it's not predefined how exactly you need to do. So that's why there's luxury to help people to come up with like more clever activities, just to providing them environment for that.
Charles, people clearly like the approach that you've taken. Like, what did you do with new technology to change things in your space?
So we compete with, I guess, three main companies, WorldCheck, as in Reuters, Dow Jones, and LexisNexis. And so what they build is these kind of massive database of people and companies who are evil. So if there's an article saying David Birch led a terrorist attack, or David Birch terrorized the defense, like, what we'll do is we'll take in 100 million pages and distinguish between those two. Build a profile of.
This is some sort of machine learning kind of.
Yeah, exactly. Yeah. So like we'll take in we'll take in your history in terms of when you were in a gang in like the 80s, when you broke into banks, and all the evil.
You don't have to use real examples.
So yeah. So basically, I guess for me, being fined billions of dollars a year and having massive teams didn't make sense, and so kind of re-architecting data from scratch and then working with partners. So I think we want to be the global omnipresent source of AML risk data, and I think just identify, is this person bad or not?
David, can I just ask one quick question? So AML5, which came in last week or something, a week before or something like that,
January.
Vastly increases the onerous requirements on people, doesn't it, to this kind of thing. So are you ready for that, or do you have to build new systems and new software for this? I was just asking Charles, yeah.
Yeah, so
I was just going to ask David something else, but I just...
Yeah, so MLD5 was a few different things. So what you had when the EU Parliament was putting it through was a few different things. You had the Bataclan attack here in Paris, So with 20,000 euros, they went into the theatre like a few miles from here, slaughtered like 50 people with machine guns, and that was done on prepaid cards. And so the European Parliament was so outraged by that, they were like, listen, we have to crack down on prepaid cards. Secondly, you had the crypto booms, all these new crypto companies which are unregulated. And then thirdly, you had the hacking of lots of BVI-based law firms, and you had the resignation of the president of Iceland, and so you had these simultaneously 3 different scandals. And specifically then, MLD5 came into effect on the 10th of January, and specifically companies now have to react to those 3 things. So I guess you got the 6th AMLD, which is the widening of personal liability and the reduction in different thresholds for transactional limits. But fundamentally, 5 AMLD was a reaction to recent events and the tightening legislation around prepaid cards, crypto, and UBOs.
And you already have that in your system to...
Yeah, so I guess it speaks to the range of... So, I mean, what 4 MLD, 3 MLD brought in was more legislation around political exposure. So, I guess what we saw recently was Isabel dos Santos, who was the second richest person in Angola, who exfiltrated billions of dollars of funds. And so she's the classic example of a PEP, stealing money from the people.
There's no rush to judgment on that one, Charles.
Yeah, okay, so allegedly, right?
I mean, who knew a life in public service could be so rewarding?
Yeah.
Would be my comment on this.
Exactly.
David, what are you doing with new technology?
Okay, so we're a behavioral analytics specialist. We develop software to identify behavioral anomalies in real time, specifically for real-time payment networks where things are moving very quickly and typically irrevocable. So think Swift GPI or UK faster payments, SEPA instant, where decisions need to be made really quickly. And effectively what we lean on is the fact that everybody has a unique payment behavior, and we can identify them anomalies not just for you, but you as a peer group. And then we can surface that, and we use a technology called explainable AI to bring that information to an analyst, whether it be fraud or an ML analyst, in a regulatory compliant way. So it's not black box, it's fully white box and fully transparent. So from the underlying data, which could have 5 or 6 variables, we could create a feature set within an algorithm that could have 100, 150 numeric variables, which the algorithm's calculating to create a score, and then we surface that in a way that a human can understand in the context of the problem that they're trying to solve.
I understand exactly what you're saying there. Just before we move on, can I just ask you guys together, just for a sort of baseline, like, is the technology basically in place for this, or are there 1 or 2 areas where we still need some breakthroughs in this area? Are there some opportunities for some new companies out here to start? On the tech side, is it basically okay? Like if you could buy some new tech...
Well, if it was okay, we wouldn't be having the Luanda papers after 20 years. Although my view on that is no technology solves that. That was just a governance and stupidity problem because everybody knew that Isabel dos Santos was crooked. Right? You don't need an algorithm to tell you that. I think the question for us is, based on the experience that the industry has already had, and I sort of want to differentiate fraud here because I think fraud we actually do really well as a general rule, but otherwise the technology that's been utilized is quite poor in its results. So I mean, your average bank is in transaction monitoring, for example, is looking at probably a 97% ineffectiveness ratio. So then the question is, from 97%, can you actually salvage that, or is it wrong? Do you need something completely different?
Just for my head, so ineffectiveness ratio, that's the ratio of...
So a 3% effectiveness ratio, if you want to look at it in a more optimistic light, I suppose.
Can I add on that dimension that fraud is done better, it's not done well.
When 3% is your threshold, it's fairly easy to be better.
So, these types of issues are very rare. Number of people that are committing fraud is obviously higher than the number of people that are committing some form of terrorist activity or money laundering activity, which are ultra rare. So they're very hard to detect. These guys want to stay undetected. They want to hide. They want to pretend to be a client. They want to. They're effectively it's like finding a needle in a bag of needles, and therefore, what we've been doing previously isn't good. Some of the techniques we're using now are halving the problem, so taking it from 3% to 6%, which is good, but it's still 94% to go. So the effectiveness, you're right. There's two issues here. There's efficiency, which is driving friction and cost, and things like false positives, which AI helps a lot and it does improve the detection. But the effectiveness of the controls and the way we deal with things is totally ineffective. And some of that comes from the regulatory side, not just the technology side.
Okay, so you guys have built some great platforms and they're working, but there's still some opportunity for people in the audience to come up with some new stuff in that space, right? Is that, you're looking more skeptical.
No, I think it's over. So.
Well, because you think just advances in AI will steadily
I think
grow.
so. Okay, so do I think there's opportunities in the space for new entrants? Like, no.
You're not just saying that's an incumbent, though. You're saying
so I think like we spent like £20 million last year, right? It's like very expensive. Like there are many so I think I've seen I was here 2 years ago. There are like 3 companies that have been wiped out that were that are trying, right? So I mean they no longer exist, right? So is it an easy space to enter? No. Is it capital intensive? Is it difficult? Is it are these problems going to be solved by niche startups? No. Do I think is it solved? No. Are there a manifold range of opportunities for new entrants? No. I don't think either.
I think it's a bit like when you get to 300 miles an hour, like a Bugatti. Getting to 310 miles an hour becomes an inordinate amount of more effort, and I think that's what Charles is alluding to. He spent 10 million, we spent close to 8 million last year in getting to where we are, and every year it gets a little bit harder to go and take the next step. But there's still plenty of room for us to...
Well, there was a conversation earlier on in the morning sessions where the guy from Forta was saying, well, because you have to, the profusion of data, you guys are doing amazing stuff with data, but of course so are the criminals. So the more and more data there is, the more the criminals have got to feed into their systems. And I thought that was kind of an interesting point on what a race this is going to be. But again, we're trying to be optimistic for the afternoon. So let's move on a little bit to talk about where we're going. I'm not an expert in this field at all. I come from the ID side of things. But when I was trying to understand from you guys the overall dynamic of this space, you talked a couple of times about this idea of shifting towards risk spectrums. And I thought that was sort of an interesting point. So can you open that up for the audience a bit for me as where we're going next?
Yeah, maybe I think the comparison with the fraud that we had in previous point, it was really relevant because to minimize the fraud, it's in the banks and merchants' interest because they're suffering direct loss. In the AML space, they don't suffer direct loss, but actually there's some just crazy regulations that are motivating to do something. So it's quite Boolean to have a license or not, and to keep the license, they're doing some extra work. But actually now, what I see with what is changing in the market is that actually the markets and the audience of the market is actually forcing banks to take more serious actions, and banks are starting to realize that, okay, if I don't find crime well enough for my system, then my share price might drop 60% or 70%. So they're starting to think okay, I might be compliant, that's good, but what else I need to do in order to minimize this risk that my share price will drop, or I will lose maybe some customers, or some new crazy fintechs are coming to take over my customers because I'm not able to handle my risk. If you think about what happened with the Panama Papers, then media and the newspaper readers forced banks to change their approach to the high risk offshore companies. Before 2016, it was okay to manage and offer services for the offshore companies, and all the bankers are saying that yes, it was not nice, but it was okay. But after this public mentality changed, bankers started to realize, okay, it's not enough, and we need to start monitoring, and we need to start putting our resources and to take proper risk-based approach, not the stuff that's written down in the laws, but actually to start handling risks. So the publicity is actually forcing banks and other companies to take more conscious decisions about how much do we want to minimize the risk versus how much we want to handle that.
Sort of the downside to that, I suppose, is that it designates the press as policymakers, and priorities are driven by whatever the most recent scandal is, which is problematic and doesn't address the issue at a systemic level. I think our view is that the data set that we have in financial crime, unlike in credit, we lack the true positive, and so therefore it's more complicated to move to a purely data-driven approach to managing financial crime risk. However, by generating a metric, putting a value in that way, onto financial crime performance, that allows financial institutions to price their counterparties more appropriately. It also allows banks to price their clients better if those clients represent a higher level of financial crime risk to the organization. I think that's the approach we try to take.
And I think compliance is not binary. It's not a checkbox. That's why it's failed in the past.
Kind of is. I mean,
Well, a lot of companies do, and if you build proportionate risk controls and you understand your business, you should have proportionate risk assessments. Certain things like small value transactions, which are contained in certain scenarios, will be much lower risk than super high value transactions which you've never seen before. And understanding the risk of the transactions you do and the types of clients you onboard allows you to have a risk gradient.
Can I just say?
Otherwise, you would stop every payment and your costs would become to the point where you can't actually run your business effectively.
Can I just want to say something like negative about proportion. So, for example, I do know a tiny bit about it from the FATF point of view because of the de-risking of cross-border stuff, because of some of the stuff we were doing in Africa and places like that. So you have the situation, I mean, just to give you a practical example, in the UK happens to have quite a large Somali population, about 200,000 people. So the UK-Somali remittance corridor happens to be a very big remittance corridor, and it's a significant fraction of Somali GDP. So FATF says you can apply proportionate controls to that, but of course no bank wants to get sued for $1 billion by the district court in Waco, East Texas. So their proportionate response is to cut off everybody in that corridor. And the result of cutting off, and I just want to make a society point of view, the result of cutting off everybody in that corridor wasn't that no money went to Somalia. It's just the money went to Somalia in crates of $100 bills from Stansted Airport instead of through electronic channels where it could be at least monitored. So the theory of proportionate is, but I just, in practice, that ends up being everybody getting bullied by the US regulator, so everybody applies the maximum possible controls. Or am I being uncharitable?
I think you've been a little bit uncharitable. I mean, I was in that sector when all that happened. I think you might have been similar with TransferWise. And we went through that de-risking, where the banks, cranked up everything. And the banks actually became your de facto regulator, not the regulators, by definition. The correspondent networks collapsed on the back of it. And we saw a lot of people get put in a lot of pain because of it.
I might be remembering this one, but I think Barclays was the last bank to turn it off.
But they had a big fight with the government over it. And the irony is the government owned RBS at the time and Lloyds and could have switched it on through that set of banks if they wanted to, but they didn't. Yes, you do get them outliers, which are extreme cases, but typically if you're managing your risk well and you understand your customers and you've got a proper controls, then typically the banks are not as bad as they're portrayed in this equation. The US banks are more diligent on this stuff, so the level of controls of getting a US bank account and moving money through the US is more difficult. It's not insurmountable.
Actually,
when I first moved to this, I'd been with Barclays for, I don't want to say how many years, it's embarrassing, but I'd been with Barclays for many years, and I walk into the Barclays in the US to open an account there, and they wouldn't open one. It's like I just got off the boat. Like my UK bank account counted for nothing. It was they could have looked at LinkedIn to decide whether to give me a bank account or not. So the proportion. Let's not get hung up on proportion. I just wanted to make a point about that. Let's keep talking about the practicalities. Another point I want to push you on. So we're talking about AML4, AML5, AMLN at some point in the future. Manifestly unproductive ways to do this, but somehow we get stuck in the loop and keep on doing it. But there are other regulatory goings on which also impact your businesses. GDPR would be the obvious one. So can you open up to the audience a little bit about what other regulatory initiatives you're responding to in your business and how you're dealing with it?
Yes, it's why really interesting dilemma we are seeing. If you think about how little information banks have actually to find the potential crime, their agents are looking one single puzzle piece and they're trying to understand what is the bigger picture around that. And they don't have any other pieces. And if we're saying that, okay, other banks have other pieces, and then if you join these data points together, you might be able to find out what is the overall picture. Just you should use proper secure technology which allows you to, and legally it's okay to share, AML point of view, it's legally okay to share data points between the banks and other institutions if there is a good reason for that. However, GDPR people and GDPR lawyers come into play and say that actually you're not allowed to do that. And it's like, it's better keep everything in your house and don't share with anyone else, even if there is a technology in place and even if there's actually FAT recommendations and the European directive is suggesting. And that's something that entrepreneurs like we need to convince banks, GDPR lawyers, saying that actually you need to read the AML laws and you need to understand that it's okay to do. So that's like big hassle, which is actually another slowdown of the AML manual detection.
So GDPR, so in sort of regulatory top trumps, doesn't AML5 beat GDPR anyway? Isn't there a clause in GDPR?
That's what they tell them, but they
Not if you talk to a GDPR lawyer.
Yeah, exactly. Depends on the background of the lawyer. If the GDPR lawyers, then they say that it's dominant. If you speak with AML lawyers, it's AML is dominant, and they keep arguing with each other, which is like nonsense. But that's what I've seen in the banks happening.
Is GDPR really having a negative impact on the business? It's a genuine question. I don't know.
Maybe because you're a data business.
I'm looking to you guys.
I didn't volunteer the GDPR topic, but you wanted to talk about it, so Mitch, go for it.
I mean, for me, it doesn't affect us.
The audience, they're super excited about GDPR, so I don't know.
Well, look, I think GDPR is a complete waste of money and an unmitigated disaster.
After Brexit.
And serves only to entrench. Yes, it's second after Brexit. But I'm the wrong person to ask. I think it's a complete waste. I think European businesses spent 8 billion euros on GDPR last year in order to entrench Facebook and Google in position as the dominant provider. So, I mean, to me, I'm the wrong person to ask about.
Cookie law as well, right?
But I'm curious on your. So, is it having a genuinely negative impact on your business, or is this just something we're thinking?
It's like liability caps, right? So people insist upon like a £5 million liability cap for like, you know, a £10,000 contract. Like, you crazy, right? So yeah, I think like.
When you say people, you mean lawyers, of course.
Like yeah, like I mean, I think the Germans are probably the most insistent upon it, and like, or they want things on premise, or so. I mean, I think there is a lot of friction introduced as a lot of people kind of misinterpreting certain clauses, right? So.
I think the only effect it has on us is when we're building models, the request that they're anonymized. And sometimes when you anonymize, if it's not done well, the models don't come out as good. So you can't interrogate them properly because you don't have the underlying data to do proper analysis. So it slows the process down. But it doesn't really affect us. What has been affecting us is, and I was in the EU last December.
We were all in the EU.
Where we had 40 regulators in Brussels around a table, which was an interesting conversation about how do they regulate AI in financial services, and how far do they regulate that doesn't stifle innovation but gives enough controls that allows them to at least have some form of influence over it, which was an interesting set of conversations.
And that's probably why Apple is now worth more than the entirety of the DAX 30 index.
I sadly think you're right, because of that data.
It's like, if you want innovation or technology, you can't like stifle it like that, right? Crazy.
Yeah, I think it would be really helpful from a regulatory perspective to, certainly to have a bit of regulatory guidance around the issue, so that you had more uniformity and enforcement. I'm in Germany, and I agree that they are the most rigid. It's also deeply unhelpful that implementation is delegated down to the local level. So I don't have to make the German authorities happy, I have to make the Berlin authorities happy, which is really peculiar. It has to do with the...
But that's no different in the US, right? NYFDS versus like FinCEN versus like, it's just this myriad of overlapping jurisdictions, which, it's always a nightmare.
Yes, true.
Yeah, but that's why there's no crime and fraud in the US, so it clearly has a positive effect. Right, let's finish on a slightly more controversial position, because I want to elevate the importance of what you guys are doing in the fintech space as a whole. So let me put something slightly challenging. You don't have to say yes or no. I'll just say it is being recorded for later transmission on the web, so we all understand where we stand. But let me take a slightly more controversial. Before, the panels before you, we were talking about advances on the KYC side, which were all very positive. The costs are falling and it's getting better and so on. And we were checking your passport online and all this sort of stuff. It's all getting better. And then we were talking about the sort of KYCC stuff, where it's getting better but not as better, checking the identity of businesses and so on, and it's all quite interesting. But I wonder if this is fundamentally the wrong model, because the model we have is this slightly Victorian model of we build this big wall to keep the bad people out, and then people that are on the inside, if they do something which we think is a little bit dodgy, they have to fill out a form and post it off, and you have, I don't know what the numbers are, 100 billion trillion suspicious transaction reports that are never, I don't even know what the answer is. But in a modern world where people have invested money in developing transistors and laser beams and this sort of thing, wouldn't it make more sense not to have those walls at all, because you guys can monitor all the transactions? I don't want the bad guys kept outside the wall. I want the bad, what's the tent thing? I don't want them pissing in the tent. No, I don't, I want them in, no, maybe the tent thing's the wrong thing. But you know what I mean? Like, wouldn't it be better just to forget about the KYC stuff completely and have as many transactions as possible in the system, where you guys are building fantastic technology to do the transaction monitoring and spot the patterns? Like, you can see the patterns that will point you towards the bad guys. And a piece of evidence in favor of my crackpot theory about reorganizing AML regulation is if you look what the guys at Chain Analysis do with things like Bitcoin, where in theory it's, but actually if you have all of the data, you can trace everything and monitor it. So here's my more controversial question to you. Is it time for a bit of a rethink on the way that the whole KYC AML thing works? Or is there some way that your technologies can make the current mess marginally more efficient?
Definitely, yes. It's like a no-brainer for me because, again, as I said, like I've been working myself as a crime detector in different companies. And what I learned that like, when I was focusing on finding suspicious transactions and suspicious behaviors, and I didn't care too much about the KYC and risk-based approach and all these formal terms, I was quite effective. But as soon as I started to apply these legal requirements, like you need to do this process, like risk-based approach, it's a separate procedure, you need to have separate technology, you need to have separate team. Sanction controls, it's a separate tool, you need to be audited separately. And as soon as I started to add these extra layers or silos, it became actually less effective from the crime detection point of view. I'm not sure how to change it. I think I know where it was coming from. It's coming from the old banking systems, which have one directory for consumers, and that's it. You're not able to link this consumer data with their transactions. You're not able to link their transactions to some other list. So it's not possible to integrate. But today, the modern technology, it means that like I have a database, I have all the customers' data, transactional data, logins, logouts, all the links in one place, and it's super effective just to do like a bit of data mining. I know it sounds easier than it is actually, but if I need to follow these hard regulatory requirements, then I'm less effective in the actual mission which is given to me. So if it's in your hands, then let's remove all the regulations. And
I saw a thing on Twitter earlier on. I mean, you were talking earlier on about these kind of verifiable sources of truth. So Twitter is mine. It's like the blockchain, but for real life. I saw a thing on Twitter earlier on where a guy had filed for his personal data from Amazon. You know, people file these GDPR requests, subject access data. He got back from a trillion billion pages of stuff from Amazon, which included every click he'd ever made on his Kindle. Next page, back page, on his Kindle. Is it another hypothesis that actually you guys are kind of really wasting your time? Because if I really wanted to find the bad guys, I'd just ask Facebook and Amazon, because they know what everyone's doing. You know, like they're the people that have this raw data that actually, if I fed that into my AI, I'd be more likely to catch things there. Are you guys, do you have a future, Charles, in this, or?
I think the answer to your first and second question is, like, if you wanted to eliminate terrorist financing, you just turn the whole world into China, right? And you have like a kind of Chinese social credit system whereby every activity was logged in the central database and everything. You know, you'd be able to stop yourself from taking train journeys or buying chocolate bars if you like offended your granny, right? I think, but given like the 210 different jurisdictions and then like thousands of different payment systems and regulations and typologies and 6 billion people and their behavior, like I think that's like a pipe dream, right? So, but yeah, you're right. The most closely related things to the Chinese social credit system are like oppressive gaffers, like and multinational corporations that have data on everyone.
If the Chinese were in charge, there would be a third runway at Heathrow, wouldn't there? Let's not go all negative. Guys, come on, are there some alternative? The way it's done now is not working. You guys are at the forefront of this. Give us some ideas for making some changes.
I think one of the challenges, every financial institution can only see to the edge of their ledger. I think this is where blockchain has a bit of an advantage, and this is where chain analysis and Elliptic have got quite interesting capabilities because they can see the whole immutable ledger. If you can see the aggregate risk across the ledger, then you have much more fidelity to understand these mule networks and these anomalous behaviors, because they will be different to typical people's behaviors. So you will be able to do a better job than just being able to see the edge. That doesn't mean you have to share data and potentially breach things like GDPR or the Canadian.
Well, actually, you weren't here, but one of the points that was made on the first panel that was quite interesting was that some of the technologies that come out of that blockchain space, things like cryptographic blinding, zero knowledge proofs, homomorphic encryption, actually are extremely optimistic technologies for our purpose because they would allow us to share and compare data without revealing people's personal information. So the technology actually does have a lot of optimism inside it. It's just, it's quite complicated technology. So it's
correct. But then so was AI, and like one of the guys said earlier, you know, it's been used in fraud and black box context for the last decade quite successfully. Not as good as it could be. The next generation's taking it the next step further. But you can share intelligence without sharing data, using techniques like federated learning. So there are capabilities and techniques if you have a wider perspective on a bigger network. If you know an actor in the network is being flagged by 15 banks as being potentially suspicious, it's likely to be suspicious. Therefore, as a group or a consortium, you can do something about it. At the moment, that doesn't happen, and it doesn't happen fast enough because, you know, we've got 40 real-time networks across the globe, and they're getting connected by SWIFT with GPI. So it's bringing in the ability to move a payment from the UK to Singapore and then out in Australia in seconds. Yeah. So you need to be able to see end-to-end and react to it in real time. So, but there are capabilities of doing that.
Listen, thanks very much. I'll say the same thing to you as I said before. These guys didn't know the questions I was going to ask them. You've got honest opinions from people who are at the absolute forefront of this industry. If you really want to change the cost benefit in your organization around it, you need to grab one of these guys afterwards and get their cards. Please join me in thanking them. Thank you very much.